Alright, welcome back. I will make a video for a while. Today we're going to talk about a special topic. How do we analyze microstructures? Okay, this comes into a lot more into scalping, which I kind of do want you to start scalping. By scalping, I mean like holding for 10 points or less, and it depends on the context, right? It's based on your experience and on your um, edge, or it depends on the environment. You can later on decide if you want to hold it for longer. Okay. Okay. We will talk more about, or in this case, refresh your mind when to hold further. Okay. So this is more so talk about the basics of the structures, the microstructure you see every day, the fluctuations like this, and then I want to show you how majority of big banks and big firms are hiding their size. Okay, we won't get much into order flow. Well, this is order flow, but we're not going to look at the DOM or anything. I will just show you your your the way what the DOM would look like. That's it. Okay, so here, let me see if we can. All right, so banks, big firms, more so pension funds, okay, dealers, market makers, they are trading constantly every day. Okay, each of them have a different motive to trade. Some would trade with a mindset of, okay, I want to enter here at set price. Some have to trade. This equates to price insensitive move, and this is usually what we want. Okay, you don't want to try to beat the market. Okay, let's try to invent something, or find an indicator and just use that as a benchmark. Okay, you need to know and understand what are you trying to accomplish in a highly competitive market like ES and NQ. All right, you are competing against millions of bright minds. Okay, are constantly trying to find the best price for for the for the trading, right? You buy cheap, sell expensive, or vice versa. Sell expensive, buy back cheaper. Okay, and this is, I would say, the the majority of your work is trying to find that inefficiencies in pricing. Okay, because there are mispricing opportunities in a lot of the times where price, if you think about of a pension fund, okay, they're trying to fill like 10,000 contracts of ES. They're not going to fill it in one go, right? Otherwise, let's say I want to let's say I want to fill majority of my price at 5,500 here, right? I'm not gonna send the moment it hits there. I'm gonna send 10,000 contracts right here and then there. If I send a buy, right? If I want to buy 10,000 contracts right off the way, guess what? There are predators, algorithms, and people like you and me are trying to feed off of these pension funds flow, okay? Or whoever have the deep pockets, right? So if you hit a 10,000 contract buys here, guess what? You're gonna have something called slippage, right? People will see this, algo will see a big flow in here, and they will either front run, right? So they are buying and then push the market up, making the banks or the pension funds or whoever have to chase the price higher. Okay, and this is not good for that firm, right? You have a huge slippage right here. Okay, slip. So this is not good. So how do you trade it? How do you fill all these price? So one way, most of the time, it is breaking up, right? And nowadays, the market is very volatile, right? Because high VIX, 20, maybe not that. I mean, it's higher than standard, okay? It's still normal market conditions. But if you want to accumulate 10,000 contracts, you have to break them in chunks. And this is why iceberg exists, okay? You're hiding the true size of your the true size, right, in the DOM. So you filter in 5 contracts each time, and this is exactly what they do. So they would fill 5 to 10 contracts in a few seconds, right? Every few seconds, like they have an algos. Either they can go through, okay, every minute fill 10 to 5 contracts, depends on the volatility, right, and the algorithm of matching algos, right? Q algo, whatever that's in K algos. I mean K algos in the bond market, or you can do. I mean, you can look into those matching algos yourself, but basically, if you have a higher contract size up to like 20 or to 30, and they would likely to prioritize these first, or you can do first in, first out, right? FIFO or FIFO. So this time based, right? So the first person to set that price at, I want to buy this price right here, 20 contracts, and the first person to set that limit, then I would fill first. But let's say someone else coming in 50 or 80 contracts, and they can override that, and they'll be the first person, okay? And that's a size prioritize trading, matching algos. So it become more complicated than that, but that is just to show you how these matching algos are trading, are trying to match the price to ensure price stability. Okay, but that's beside the point. But let's go back. Okay, let's say I want to buy right here. I want to buy 5 contracts right here, and I start to fill in. Okay, every few minutes. Let's say, assuming it's within. You can't always have zero slippage, right? There's no way I'm going to fill everything at 5,500. So now, guess what? Because of that, and we know that, we have something called range. This is the fill range, right? There's no way I can fill everything here at here, 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 right? It's very rare. I have to fill some here, fill some here, fill some here, right? Along the way. And that is exactly what they are doing because I do it. Okay, there's no way. Okay, the market is very efficient, and during these fluctuations, this is why we trade. Because of us keep filling 5 to 10 contracts, some smart people will look at the flow and be like, okay, every 1 minute I see somebody keep filling 10 contracts at a time. So in the next 5 minutes or the next minute, I can, guess what? I can create an algo searching for this flow. Okay, let's say they found out the time every, more specifically, every 32 seconds. Okay, every 32 seconds, the pension fund buys 10 contracts. And an algo, so this is algo A. Okay, this is algo A. I think I talked briefly about this stuff on the previous videos where you have algos are playing with each other, right? This is more in depth. Okay, so algos A tell from this pension fund to buy 10 contracts every 32 seconds. Why 32? Because it's odd. Okay, this is a very simple algos. It's very odd. Okay, if you buy every minute, obviously everyone would see that fucking flow, right? Every minute, so they would front run every minute. So this guy a little bit smarter. They use 32, maybe not that smart enough. We were trying to figure out how and why to make it a little bit better. Okay, so every 32 seconds, algo A buys 10 contracts. So another algo B, or a smarter guy, oh, that's a bad B. B comes in, realize every 32 seconds there's a buy contracts at this range. So guess what? Algo B comes in and buys before. Okay, buy at 31 second. Lift the price up. Okay, market in aggressively, lifting the offer so that when you buy here, Algos B comes in and buy here, lifting the price up and make the Algo A buys here at that level. You see what I mean? So Algo A's buy there, Algo B buy here. And when Algo B buy here and Algo A start to buy here, who's selling that to A? The B guy does. So B comes in and sell with the difference. So at, let's say here is 02, they're going to sell it at 05. So they make a 3-point trade and extracting out the inefficiencies or that lifting the offer. This is how algos make money. This is how front running works. Okay, because when you buy, you become the seller, right? You sell back to A. So now A have a 3-point slippage. Okay, so guess what? Algo C sees this, and now front running Algo B. So now they buy every 30 seconds. So they get the price in front of this guy. Now it's become a loop. You see? Now C does 30 seconds. Guess what? Another guy, D, comes in and be like, whoa, 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 whoa. A, B, C both buying in. What if I really want to short it down? So every, let's say every 29 seconds. Okay, maybe this helps helps them buying cheaper. Okay, but in a way they become more cunning in a way. Okay, Algo D saw this and they keep pressing the price up, right? So guess what? Algo D comes in and short huge chunks, okay, around here and push through here. Okay, push through this line. Guess what? When they push through this line, it pull through here and price, let's say at 29.5, price reach here. But before it hit 30 seconds, okay, D buys back all their profits, buy back all their contract that they short here and more. Okay, they trigger something called a sweep, right, or a flash tick down. Okay, and then tick up right away. And when it does that, they buy double the size and they sweep the whole thing. And when it sweep the whole thing like this, goes down, sweep higher, so that force B, C, A, whatever, right, to buy a lot higher here because everybody, this D algos suddenly injecting or taking in a lot of liquidity that force other algos, E, for example, or F, comes in and detects high buying deltas, right? You have an immensely short delta here, and then conversely a very positive delta here, and press the price so much that the difference between these deltas activate E and F algos that force E and F to buy along with this over here, thus pushing B, C, and A buying with more slippage up there. Okay, this is a big concept. Like I've just talked about like 7 algos, 6 algos, just playing around with each other, and the A guy is the one who damaged the most. Okay, so pension funds know this, and this is how they hire the best minds to fix this, to get the best price, right? And this is very hard for them to do so because everybody is trying to get the good price, right? The best price, right? So the gist here is the best price is the price that visit in the least amount of time. Okay, because nobody would like to trade in this area. Most of it, well, a lot of people do. That's where you have this um, this volume profile, right? But for the sake of trading, no one wants to buy or sell at the POC. People usually um, trade revisit of the POC. So price going down like this, hit, and then you short here and goes back down. It will get rejected, or it accepts the POC and it comes above, test the POC again and comes back up. Okay, so that's kind of how I told you guys to trade POC, but majority of the time I don't want you to trade within the POC because price fluctuations so much here, because they're trying to, these are where the short-term high-frequency algos are playing in this realm. Okay, this very tiny move right here are their money-making tactics. They're trying to manipulate the bid ask to gain to their advantage. So here, other algos or predatory algos will try to do faking, right? So they fake out. This is quite illegal, but I mean, they can just be like, oh, we don't want that price anymore. There's really no way to prove it, right? So now those algo come into play, and now you have a series of millions of algos trading with each other, and that's why we see a lot of fluctuations. Okay, so that's pension funds or big firms who are trying to trade, or prop firms, right? We're trying to get the best price possible. Market makers, on the other hand, or dealers, are delta neutral most of the time. They don't really care about the directional deltas. They're more so interested in taking the spreads, right? So I sell you 5, I buy back, I bought it for 4 and I sell you 5 to take that $1 difference. Okay, and that's what they're interested in. As much volume as possible, and then hedge their books. Okay, so because of this, they don't want any market delta or directional risk, so they must hedge. So this is where you have insensitive pricing comes in for one of the entity. You also have something, let's say a distress margin calls, something like that, where they're forced to get out. This press the price even lower, and people can take advantage of this. Okay, it rarely happens, but you can see that in April you have those things when you prop firms or big firms are getting margin calls and push the price down because they're reaching their margin call P&L, right? They're losing X amount of money. Now it's time to close. The banks call them, just like you guys. Okay, broker comes in, call, hey, you reach margin call, we have to sell out your position. So when they sell out the position like this, they have to sell it out. There's, you can't just say no, you know, you have to sell out. So this pushed the price down even more. And you can profit this by anticipating such move so you can sell there and buy back lower. Okay, so that is price insensitive trading. And that's edge. You need to know how to anticipate those things. Okay, be like, okay, at this point, if market is trading in a certain way, and you know that they're going to puke, right? Which is one of our core ideas here. It's not because it's never about you being right. It's about others being wrong. They're being wrong about their trade locations, and they get margin call for it. Now you press them out, and that is exactly what I'm trying to teach you here. Okay, you're finding you're here to find those price inefficiencies so that you can exploit it yourself. Okay, you have to be very cunning in this market. Otherwise, people will take your money, lunch money, every single day. All right. So, how would this translate now? Let's talk back to microstructures. Okay. How can you exploit this now? And you know that market is random. Okay, random most of the time. But but it is not so random in also many times. There are few times if you really look into it, you can realize that, okay, maybe the market is not that random. Okay, you can't you can't analyze every buy and seller intentions, okay, and why they do it. Okay, this is why the market is so random. You have predator algos going in loops and loops and loops like this. That makes the market somewhat random. It looks random, right? But in a certain places, right, it is not so random at all. And we're gonna stop there for now. I don't want to go in depth much into it, but and obviously it's not why you're listening to me, right? You're here because, okay, how can I exploit that non-randomness movement to my advantage? Okay, so you can see here, market going up and down in waves, right? It never really goes straight up. Okay, if it goes straight up or straight down sometimes, okay, that means there is some sort of big movement trying to flush them down, or people getting stopped out, right, or margin call, whatever this, or a lack of liquidity or mispricing. Okay, some models now misprice and they pull out the bid and ask, leading to a flush or a breakout, you would say. Okay, so because of this, because of this, and I did mention that it is inefficiencies. Okay, this is inefficiencies in the market. An efficient market is the market that has every buyer for every seller at certain price, at any price. Because it has buyers and sellers in equilibrium at any price, it can only be traded in one price. Because if everybody agrees on, okay, let's sell ES at $5,000, and buyers and sellers are like, yeah, let's buy and sell at $5,000. Everybody exchange hands and nobody get anything. It would both be a negative sum game because of commissions, right? Market would not move at all. This is efficient, right? The price would just stay the same. And they also assume that every information is known. So because of it, there is no uncertainty. The market will always be certain. I'm certain that tomorrow, when I open the market, it will still be at 5,000 for ES. If I open the market at next year, the price of ES will still be 5,000. There's no there's no there's no uncertainty anymore. Okay, you know damn well I can buy that ES contract at $5,000. It's like buying the iced tea, the Arizona iced tea, is still priced at 99 cents. You're certain damn well that next year it would still be at 99 cents. Okay, that's how efficient that is. But the market is not that efficient. Okay, they are very efficient in taking your money away. That's for sure. But it is about 95% efficient. That 5% inefficiencies there is what cause price fluctuations. And in certain periods, that inefficiencies increases. This increase in volatility. Well, there's another step before that, which is reducing in limit depth in the order books, right? Because people don't know what to price or how to price it, they pull out all the quotes. Okay, so you have a thinner DOM. Because if you have thinner DOM, it translates into volatility, right? A thicker market, like bonds, it moves less. But a thinner market like gold, oil, or an NQ, it moves more. So the liquidity in the market is the core DNA of how much of a movement the market moves. Okay? So when we move in a big way, something like this, right? In this very tiny moment right here, from here to here. Okay, this is inefficiencies in a way, if you think about it, where they misprice here, 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 all the way, all the way. This whole 4 candles right here is a misprice. Okay, either firms look at this and be like, okay, maybe ES should not be here anymore. We have to sell more so that we can match the right price that our model is telling us. Okay, maybe the right price at this moment right here is about 55.25, and they want to short everything to match their current model projections at 55.25, and they close it, right? And that's how they make money. So the model is trying to find mispricing, right? Which is pretty much all core models are, right? If you look at indicators, right? If you look at all the indicators, well, most of it, you see that, okay, it was trying to look for stability or certain mispricing. Let's say very, very simple EMA, okay, an exponential moving candidate right here. So EMAs is an exponential moving average. For this case, it's average out the prices. What that means is it's trying to tell you that at this price right here, this right here is the average price. So therefore, if any price go higher than that, is called a misprice. So guess what? People would short it to match with the same EMA. You you get me? That's mean every time market is fluctuating outside of this, they have a stronger tendency to flip back into that average price, or in this case, exponential moving price. Okay? So that means at this area right here is mispriced. So people buying back up for 48 for around 40 ticks. So this is a 38 tick mispricing. When it hits this, they sell. Okay, and according to this, and every time it goes below here, they can buy it back to 12. And above here, they keep. So now, as it goes away, now more people were looking to short, right? So you can see that most of the indicators were trying to tell you, okay, there may be a misprice. There may be a misprice. In this case, let's say if we go back to it, right? Now there's not so much of a mispricing anymore in this area, right? Because market has now become very efficient at this. Okay, now we can say that in this moment, in this 2 hour here, you can see that we are in equilibrium. There are a huge amount of sellers and buyers in a tight spreads. So there's not much of a mispricing here. So as a scalper or a big move player will look at this and be like, okay, there's not much I can do here because the market's thinking is it's in equilibrium. So I don't need to trade here. I would trade when there's a huge misprice and the market forced to come back to that set price, to the price that either my model say or the price that my indicators say. Okay, and that's basically the gist of trading. You trade because there is a certain price you think or the model thinks that is wrong. Okay, that's why you trade. You buy low, you sell higher because you're thinking at this price that you buy is cheaper than the actual price of this market. So everybody buys, everybody agrees with you, they buy this and they bounce the market back up. But coming back up here, you're thinking, okay, maybe the price is a little bit too expensive that you think it is. My model is saying it's about 55.50, right? So everybody sells, reaching that price right here. And people who thinking, okay, maybe 55.50 is a bit too cheap, so now I'm going to buy it up. And this create buying and selling waves. Okay, this explains the randomness of the market, quote unquote randomness of the market. Okay, so you make money by convincing the market or players in the market, participants in the market, that this set price is cheap, okay? And you have to be faster than them, and that's the game. Like I mentioned before, the best price is the price that doesn't stay there for long, because the moment everybody starts realizing this price is cheap compared to the real value in this instance, right? The next 10 minutes is this price is cheap. Guess what? Everybody will rush to buy it. Thus, decrease the difference in price, right? If you are thinking, right, $5 is cheap and the actual value is 10, and you start buying at 10, you have a $5 difference, right? But guess what? The market is also smart. They also think $5 is cheap, so they start to buy ahead of you. So now you can only buy at 6, and you only get a $4 difference. This right here, this difference of $1 here, that means the market has become more efficient and efficient, right? It takes out that $1. It reduced the difference in the value here and the current price. It is now more efficient, and more people buying. More people are buying at 9. You can say that this $1 difference here, that means the market is going to that efficiency of 90%. Okay, so at this moment right here, the market is not efficient at all, according to your model, right? Maybe other models say this is efficient, this is the right price, and for this example, they are wrong, right? So some people will sell to you at 5, right? They will sell to you at 5. They think this is the right price, so they sell to you at 5. You think this is the wrong price, you buy it at 5. And the market agree with you, they go up to 10. And these guys forced to close out because of their idea is wrong in this instance, right? So they have to buy back at 6. And this further push the price towards this $10 value. The true price in this scenario is 10, right? So you can see that everybody is rushing to get that good price. That means you, as a slow person, as a mechanical player, you are at risk. Okay? If you're not fast, you can't get the price here, you have to get the price there. You have to get the price here. So that means every time you're slower than them, okay? Anytime you're slower than them, you are reducing your profit factor. Right? You're risking 1, so you can make that much. But every time you're slower than them, you have to buy here. So now your profit factor is only this much, and you risk a lot more here. Here you only risk 1 to make 4. Now you risk 2, right? This is 2 to make 3. You see what I mean? So your EV just reduced by that much. Okay, let that sink in a little bit. And this explains why when we do the actual trading, we're not trying to look for the win rate or the profit factor. Okay, if you keep thinking like that, okay, how do I improve on my profit factor? You are going to be crazy. Okay, and that's not good. So what you want to focus now is the process. Okay, the process of getting that price that you think it is inefficient. So let's come back to this. We said that this 4 candle right here is mispricing inefficiency. Okay, they think the price should be lower. Because of this inefficient, we can also reason that maybe this pricing down lower is also a misprice. If you, it's a little bit counterintuitive, but this movement right here is a few man. I cannot say one man because there are probably a lot of participants that trade this down move, right? Some people, okay, they think this is mispricing, so I'm going to short with it, and they go with the momentum, right? So a collection of traders here thinking this is a misprice from here, so they sell, and they reach here. And now a collection of traders here now things, okay, this is the next sequence. Okay, this is the next, we're thinking about the next sequence here. So now they think, okay, now this is the good price. This is the model pricing right here. So I'm gonna close my position. So they buy it back. Because of this buying back, this price right here in this sequence, the next one, right, the upcoming one, now is another misprice. So guess what? People buy here because they think at this set price is inefficient anymore. So therefore, they buy it back up. This creates a leg. So they misprice this bar and they buy it back up to back into the previous place. And from here, they recalibrate again. Look at this wick right here. This wick right here. Some people think this is still a misprice, so they push it down. And during this moment right here, there are more buyers or there are more players thinking this is not good enough for mispricing. They should be higher. So they buying all the way back up, flushing all these sellers out. Because these sellers are old thinking. They used to think what they thought this price right here is a bad price. They must go down. So they translate into actions. They press the sell button, pushing the price lower, right? But there are more aggressive trader thinking, okay, this is also a good price to buy it up. So guess what? The price goes up. Okay, I'm like analyzing huge chunk of info here, trying to digest every movement of this. So if you keep analyzing every fucking tick, every fucking candles, that is what you get basically, right? You can reason throughout all these moves and how they move. So that means every sequence is a mispricing sequence, right? This is mispriced because they think the market is too high up here, so they push it down. When they push it down low here, they think it's a misprice and they push it back up. When they push it back up, they think this is a misprice, so they push it back down. And they think another set of sequence think this is a wrong price, so they push it back up. So market goes in waves. Okay, market goes in waves. So now, how can you trade this? Right? Now it gets to the next concept of your model. Your model should not prove this is the right sequence. Your model is trying to prove this is the wrong sequence or the wrong idea. Okay? You're trying to prove that these players are wrong. So therefore, you trade the opposite way. You're never trying to prove, okay, they are right, so I'm gonna go with them. It doesn't work like that. You are going to get very behind very fast. Okay? Because you're trying to anticipate, you're trying to predict the future, which is super hard. You don't even know what you're gonna do at this hour tomorrow, let alone years from now, 3 months from now, like Jim Cramer, or trying to predict, oh, this market is going to do well in the next 4 or 5 years. No, nobody can predict things. Nobody knows what's going on. Even I don't. Okay, I'm not here trying to predict the future. I'm just here trying to press buttons that flush people out in different ways. Okay, this translates into price changes, and it happens to look like I predict the future. But it really is not. That's not my goal, right? I'm just here to flush people out, and you should think the same way. So how do you flush people out? By utilizing or exploit those moves, those fast moves, okay? Because their move is so fast like this, in this sequence of these 4 candles here, everyone is in synchronization. And like in almost every time you synchronize something, it's gonna get worse and worse. The trade become overcrowded. as you say, right? Look at this bigger sequence. Everybody trying to rush buy, sell, 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 sell. At some point, right, it becomes overcrowded and there's not enough sellers anymore. All buyers become sellers, but eventually all the sellers have to become buyers to close their position out. So you have to be near the exit door to get out before the price rush backwards. Okay, before every sellers here turns into buyers. Okay, can you time it? Well, it depends on how good you are, right? So you have to think ahead. How, when you look at these sequence right here, before it happens, how do you know it's a change? Okay, how do you know this is going to revert back or when sellers become buyers, right? So we have to look at that fast sequence, that the moment when you dissect even more, right? This is one synchronized move, but in this big move, there are also a few you can dissect further out. There are a few more synchronized moves, which is from here to here. All these three candles right here, 1, 2, and 3. These three candles right here are synchronized moved. Okay, when it's synchronized like that, there will be a certain players who trying to fill in this inefficiencies because we assume every synchronized move like this it is an inefficiency because it's quote unquote overcrowd. So players or traders would try to buy back up and fill back into these inefficiencies. So therefore you create something called a range, right? So they create a range here. So let's mark this range. So it would be this range and this range. Okay. So then you have another flush. This next three candle right here, right? This next three candle right here, this one down here, is also an inefficiency because it becomes synchronized again. So now you can also mark this area right here is another box. They're trying to fill that box. Okay, they're trying to fill that inefficiency. So you can see that we're trading range to ranges, and each of those continuations is inefficiencies. They're trying to fill that out. So when price goes away from the box and go back into this range, this is a bad example because it's moved so little, but you can see that it tends to get rejected, and people or whatever it does, right? But when it get rejected of this range right here, it tends to continue a little bit with more inefficiency because people are thinking, okay, if it get rejected like this must be the wrong price. So therefore, I must have another inefficiency sequence, okay, trying to push the price lower. And eventually, it goes back up. Now, this location right here, when price rejected, and when we come back it up again, price now getting accepted instead. So now you can see that, okay? You can see that because of this. Okay, look at this midpoint right here. Price is getting accepted here and push higher than this upper box now. You can see that, okay, maybe this whole sequence here is a misprice. So we're looking at a bigger picture. Now we can think, okay, this is not good. We have to go back. You have to be thinking ahead, okay, because if everybody thinks this is now a mispricing, they're gonna have to buy back up, going back to this area up here, okay, at this set price. So at 55.20 right here, they are in equilibrium of buyers and selling this two sequence because they're thinking, some sellers thinking this is the wrong price, they should be lower, and buyers thinking, okay, this may be a cheaper price to buy here, so they match. Therefore, you see dojis. But this candle tells you that there's more aggressive buyers and trying to prove these sellers down here, from here to here, they're wrong because everybody who sells from here to here are now under the water, and now they're at risk. If they will be at risk for going to their stop, right? So now when this candle is happening, there is acceptance up here now, you can say that, okay, you can trade, right? You can buy here and predict, or trying to predict the next set of candles are going to be going back up to this inefficiency price again. So now you're trading range to range, right? So you set buy here or here. You're thinking at this moment you hear, okay, I see this upward move here. I can hypothesize that everyone here is wrong. So now I do the opposite. I buy it back up, and the market is accepting here, going through. They're always trying to fill that inefficiency candles right here. These three things. They're always trying to fill back up. And they go back up to this midpoint. That's 94 ticks of difference. So if you buy there, if you buy up here, you get 94 ticks, 91, whatever. Not even down here. This is what I'm trying to tell you. You don't try to pick tops and bottoms. Okay? You can make money by literally going and trade in the middle of this sequence, and you still get good money. And they come all the way to the top right here. Look at this top sequence right here. It reached and it falls back down. And then later on, it goes even higher, okay, of the next sequence. So that means you can make money right here and there, and maybe target some runners going up above this box, right? And that'll be your trade. And guess what? Look at this sequence. Big up, big down. Okay? And at some point, this is also inefficiency. So they were trying to fill in whatever inside here. So guess what? They go back up. So they're trying to buy back up. Every time you see inefficiency, they're always trying to retest that area. Okay? Every time, if I keep scrolling in, you can still see, okay, they're filling back up this inefficiency. Look at this inefficiency 4 times in a row. Guess what? Like, I'm not cherry picking here. I don't even know what's going next. Okay? At some point, it become a pennant and it rush back down. And eventually, they would test somewhat, right? Look at this. It goes above the box a little bit and reject it down further. And here, it's also an inefficiency. Now, you're buying back up. See this 4 candles right here? Guess what? It's also inefficiencies. It's gonna fill back up again. So now you can see that market goes in waves. Okay. Now you can start to see that, okay, maybe it's not that random anymore. Okay, and that's how we trade. Okay, you're thinking right here, you think the market at this point would not go down and fill this, right? They were likely to go down and fill this up down to here, right? Market's efficient, and boom, boom, right here. Slowly move down to this target, and all the way down. Look at this, back up again, and that's how you scalp, basically, right? You're thinking they're not going to return this? Eventually they will. And guess what? You think they're not going to return, then they're not going to take out this? You have one here, one here. Okay, this is a good sequence. This is a bigger sequence to talk about here. So you have right here and right here. The price will do this. Will fill back up. A void, right? That is somewhat volume profile 101. We hate voids. We hate zero. We hate low volume nodes. Okay, boom, right there. So even if you buy here, and you close here at this candle, let's give right here. You're buying it up here, you're buying above this candle, and you close right there. In 1 hour and 3 minutes, you make 96 ticks. Okay, this inefficiency candle, you can buy from here above this tick and going up here, and you make 122. And from here, you can play the next sequence, right? Fill all these voids, right? This becomes a little box right here. And this becomes a little box right here. look at this. Every time prices come back to this box, they are now thinking buyers are going to fill that sequence up. So they got rejected here from this box because guess what? They're still thinking this is still going can go lower, so they sell more. But the moment the trend reverse, guess what? At here they will buy here instead of sell, and they fill in this box. Look at that. They fill in the gap of that volume gap right there. So it correlates back into what we talk about in the volume profile, right? Or auction market theory. You can see that if we test one side, we're going to test the other way. So fast move, right? Like I said in a lot of the times in previous videos, fast moves are very dangerous because in a psychology wise, right? When you think of fast move like this, you are convinced. The market is trying to convince you, hey, get in here quick. We are going to move, baby. We are going to move the market. Guess what? In all the times, you will get trapped into thinking such ways. This is why a lot of scalpers are mean reversion traders, okay? They're mean reversions. This is why mean reversions happens, okay? Because of the not so randomness move like this. Look at this big look at this candle right here. You think they're not going to retest that? They will. Guess what? When they retest, they will retest a little bit lower to trap people out, and they continue to come up because I can draw this exact same goddamn candle right here, from here to here, right? So from here to here, from this price to this wick right here, I can do that too. There's no way stopping me. What it matters is how good you are at drawing and figuring out all these boxes, right? These boxes here is in a way inefficiency boxes, right? And if price go through it, that means if let's say here, price decide to go through this box, that means this box is wrong, assuming you train mean reversion back up, right? So again, you're trying to prove that somebody else is wrong, okay? That means anytime when price hit down this box, it means that any person who trying to go through this box is wrong, and you're trading the opposite of that person. So he thinks this guy trying to sell here, this guy trying to sell here, thinking they should go lower. But as it reached this box, the buyers will see this and buying back up, proving they are wrong, and you trading alongside with the people, the algos who trying to predict that these red three candles participants here are wrong, so they're buying back up higher. So they're trying to move the price higher, and that's what you do. But when the price go through, guess what? Your ideology is wrong. So your stop is going to be around here. Okay, because if it go through, your core model, right? You're trying to prove these guys are wrong, but it go through it, that means they are right. So now risk management comes in. You have a set target. Okay, if I see this box, guess what? If it go through this box, I'm wrong, right? You can simplify like that. It doesn't try to make trading simple, because if you keep making it so hard, all of this stuff for the past hour that nearly an hour now that I've been explaining to you is very conceptualized, and this is very hard to digest because everything is random. How can we justify randomness in 1 hour? What I just told you guys is a very surface level of trading, believe it or not, even though they're maybe a little deeper than a surface level, but it's very dense, right? This is one of the hardest jobs in the world. So, guess what? Our goal is to make it simple. Same thing again here. How am I going to draw this box? It's going to be around from here to here. All right, so if I see price come back to 60, assume it will, eventually. You know what? I'm just gonna mark at 60 here. Okay, we're gonna keep going. We're going to see that at some point in time, that 56, 55.60 will be a price point of interest. Okay. So now you have those areas of interest to play. Look at this sequence. This is a good play. Market rush through it, and they say stagnant overnight. And at 7 p.m., they brush it back up for 200 ticks. It's crazy. Same thing here. Guess what? The market fell back down. Fell into this area right here. So you can see that in some ways you can trade this scalp mode. Okay, look at this. You can short here and go back to this area right here, 60 ticks. Here, also in inefficiencies, right? In a way, let's say market makers are going back and hedging in this area. They hit a gamma node here, and they're trying to sell and hedge their books. This create these candles. This, in a way, contradict other models that's saying, okay, this price is too low, so they're buying back up and feel that inefficiencies. They feel right to that wick. Is it random? I don't know. You tell me. It feel right at that bottom wick right there. It become the top here and rush it back down. Because of this inefficiency. Next up, this candle is an inefficiency. They pulling back up again. Do it. So now my question is, do you trade all inefficiencies? No. You trade the one that you think it has the highest amount of move. And in such a way, right? Will I trade this inefficiency? No. Right? So now you have to go in a little more in depth about, okay, now I know the market is not so random and we can trade these inefficiencies, right? Now I have to narrow down. I can't trade every inefficiencies, right? I can't do that. It's way too much for a person to handle. If you're building algos, sure, but you as a mechanical trader, you can't do that. So what do? You have to be more selective on your trades, right? You can say, okay, let's say if the market move 80% of a normal range or up and down big, I will look into trade it. If it's too small, I'm not trading it. So it depends on your experience. Right, let's take a look at this one. Let's see if it does. I have no idea. Oh, look at that. Stop right then and there. Maybe a little bit higher. But what the fuck is this? This inefficiency as well. Goes all the way back down again. Try to retest it. A little bit lower. Trap everyone else. And boom. Goes straight up. This inefficiency right here. I still remember. Oh, I think I remember this time. It's like news coming out and everybody just like should buy. Hit the offer and everybody sell all the way back down. Okay, that's inefficiencies. People removing the bids and ask. Okay, market doesn't know what to do, so it shoot all the way back up. Market makers now the model is telling them, okay, this is the wrong price, so they sell it back down and meet the equilibrium here. And auction market theory is saying, okay, if it hits here, we should go a little bit lower. And so there it goes, right? What else? A little bit here, retest. You see this right here, retest, right? That box here. Hit right there in the middle of this and then back up. You think this is not an inefficiency? Think again. Retest all the way back here. Okay, from here to this wick right here. And it goes back up. It retests multiple times again into this inefficiency. You think they're not going to retest this area right here? Wrong. They retest twice. They boom a gap. Boom a gap. They will come back down and retest inefficiency. So you have something called a halfback. right? At some point you will see halfback, and they just a little bit below here, so it depends on the context, right? You have flush down right here, inefficiencies. They're rushing back up, correcting this inefficiency. Now this becomes the next inefficiency. They retest back down again, trying to correct this inefficiency, and then go back up, correcting this inefficiency. Right, so it's all about the next sequence. You thinking this is not an inefficiency? Think again. It will go all the way back down. Okay, until it meets until it meet a price where buyers agree and to buy more aggressively and push the price higher. Do you think this is not an inefficiency? Guess what? Boom. I will keep scrolling, and I can keep telling you that market will fill in those gaps. Okay, maybe not in that same moment. Okay, maybe the day, let's say this day, you see this, you're like, yeah, the price have to test on that same day. No, not really. Depends on the context, right? The price will retest this eventually, but you have to know when that is, and that is the hard part, right? Sometimes it hit downstairs and goes back up again, right? Eventually, it will test all of this. But you have to understand another thing is the market is designed to go up. So expect that when they retest down lower, you will meet with more buyers waiting below here and flush and then continue to buy up in a wave, right? So you have higher lows, higher highs, right? Every single time. Well, I'm not saying every single time, most of the time, right? And then sometime when you have huge price correction, um, this is a expiration on Wednesday, I believe, right? Huge. I keep telling people to watch over here on the XPX 780 or something like that, 750, whatever, right? But watch that because there is some force of market makers are trying to hedge their books, pushing the price down to that local negative gamma area, right? So this also in inefficiencies, right? And we have not feel that yet because now we are on a downtrend. But look at this on previous on this Friday, right? This huge inefficiency here. So you bet your ass that they were trying to fill this box eventually, and yes, they did. They fill it with sweet volume all day long, the whole day. 6 hours of trading within this box. Okay, maybe a little bit if you count here, but then they never left. The price is still at midpoint right here at the close, right? And that's trading. That is just trading. You think price will not come retest this? They might be. They will eventually, right? We don't know when. So you have to tell yourself, okay, when it retests, then I assess my trading, and if it aligns well with my intentions and my bias, I take that trade. Okay. Uh, I did long right here to create that inefficiency myself. So I saw this. I know the price is going to fill, right? But I want to trade this sequence only. So I trade that sequence. I bought around here. These are my fill wicks. Try my best to fill my price, and then I sold around 18 average. Okay, market keep continue to go up, right? I could have continued to trade, right? I'm pretty sure some of my guys in my desk trade these too. And guess what? These are inefficiency. They might fill back down again, and eventually at the close they did, because set price or average price that belong around that box is around here, 58.15, 15. Yeah. So the, that's trading. I don't know what to tell you else more. This is probably a long video already, right? So you can utilize this, okay? as one of your trading models. You have to have a system, okay? You have to have a system. And then once you find that system, you have to backtest it. When you backtest this, you should have your stats. Once you have your stats, you can utilize that stat to improve upon your risk management. Okay, when am I wrong? If I'm wrong, I have to get out. Okay, when are they wrong? That's where my model lies in. But when I'm wrong, that's my risk management comes in. Okay, in this, if you have good risk management, your P&L improve. Then it does improve your profit factor. Okay, another thing that improves profit factor is how fast you are in identifying this. This comes down to executions, right? So I think that's it for this video. I think it's long enough already, but I hope it helps you guys. Okay. Oh, that is amazing trade. Yeah, the down movement. All right. See you guys next time.